Anakava from Tide Protocol. Is Enzo in the room? Okay, so Mariano will find Enzo. Otherwise, we may have to have an emergency substitution. Okay. You're on stage. Oh, there's a lot of good stuff here. Okay, so I'm going to have you stand over here since you're the moderator. I actually get to sit down for once. STOs from the issuer's perspective.
All right, so this should be a little bit more fun, hopefully. So I thought that we would start off with, okay, so here's the actual premise. You launch a token, it's trading. You now have to deal with token holders, you have to deal with the government, you have to deal with actually jurisdictions, you have to deal with the kind of investors that might have put money into your company, you have to deal with the fact that you want other companies to potentially use your actual token, right? So you have all that stuff going on. So from the issuer viewpoint, you know, I'd like for each of you to kind of tell us who you are, your project, but also give us a sense of what challenges have you been facing, and where do you see the benefits in doing an STO or an ICO versus doing a normal equity round? So, would you like to start, please?
Hello. My name is Brian Santos, and I'm here representing Vault Logic, one of their lead salespeople. And what we've essentially built is a full cases Bitcoin ATM and BTM machine that allows you to convert cryptocurrency into fiat and fiat back into cryptocurrency instantaneously. And you can also buy mobile points, mobile minutes. You can pay bills. You can do bill pay on the machine. You can send money. You can do cross-border remittance, and there's an entire platform that we built out that lets you add apps to the store. So it's a customizable machine. It's modular in a sense, and we've launched our STO. You can actually see it on vaultlogic.com/STO, and it's essentially a revenue royalty model. So if you invest into Vault Logic, you get a piece of revenue that every single machine makes on the network. So it's a community managed pool of resources that come to all the investors automatically through a smart contract on our blockchain. So it's a new way of doing a Bitcoin ATM machine.
Hello, I'm Eugene Kesselman. Simplest way to put it, what we do is, everybody calls it an Uber of private jets, but essentially it's a platform for selling private jet charters. It's a fairly complicated platform because it involves moving a lot of very expensive inventory all over the world. From the STO perspective, we took a little different approach. Because we're in the era where there's been many ICOs that quite didn't make it. And I think one of the fundamental challenges when I first started hearing about ICOs is that the people who invested had no stake. They were not, they were there for the element, but the companies had no accountability to them as an investors. They were not even entitled in some case to company reports of how the company is doing. So there were communities of people investing billions in dollars into a premise that it'll do something, and it wasn't. So when we went out and put the STO together, our first obligation was, and it was said earlier today, and I just find out how it's called, what is it, an investomer?
Yep.
Right, and that's the approach you want to take. So in our scenario, we try to address it the following way. First, we want you to be a shareholder, because a shareholder is an equivalent of a what's it called, NPS, net promotion scores, right? Because you're going to promote, even if you invested as little as a 1 token or $1 equivalent, right? You are the promoter. So you should be a shareholder, and because you're risking to support us early, you should be rewarded. So it's not just being a part of something, it's being a shareholder. It was very important for our STO. The second point is, in the preparation when we started doing PPM, and it's a grueling process, and most of you probably seen the PPM. It's a 70% negative content document, right? And then there's 30% that talks about what you do and how you're gonna do it, followed by another 10% of negative content about how it's not gonna happen. But the reality of this is, after reading about 30 of them, we realized that nobody's paying dividends. And everybody's putting restrictions on their tokens or securities to where, why would I support you? So again, using the same analogy, our model is you are a shareholder with dividends. And only then you're going to be the promoter of the application. And then the biggest question, why to do it in 506C and Reg S like we're doing it concurrently? And it was because in the business we're in, it's a high net worth clients. Our retention is 98% rebook rate. And we have 17,500 people we can go to today and say, would you support us? And I guarantee you, 98% of them will send us some money. But for us to do this STO meant 3 things. First, we wanted other people who are not part of our client base to buy a share and become a fan and start using the service. So rule number 1, and that's why the minimum cap and the minimum investment numbers are high, right? Because we want the right kind of investor. But the second part was to generate transparency and try to reestablish the image of folks who are using STO, formerly known as ICO, unless it's a true utility. Because if we have more responsible and accountable companies doing it transparently, making them shareholders, and just doing it under this new platform, we collectively stand a chance of changing the tide. So those sort of things were, the accountability was very important in our STO. And if anybody has interest to download a presentation or see the PPM in action, it's the same name as a company, TopJets, but instead of .com, which is our production platform, it's .io for you to be able to go see all of those things.
Thanks. My name is Isaac. I'm with the Tide Foundation. The Tide protocol effectively makes privacy profitable. We created an infrastructure for personal data, and in doing so, a 3-sided marketplace for consumers to be able to control and own their data, for businesses to be able to remove the liability of holding personal data, and for marketers to be able to reach out to those businesses, identify the end users, and incentivize them to share the key for their personal data. For us, an STO was really the only viable model in a nonprofit scenario where we've got an infrastructure level protocol and a nonprofit entity that's managing it. There is no equity within the organization, so there really wasn't the option for us to go down any other road. And it actually ended up being quite an elegant solution and something that fits very well in terms of having a sustainable entity which is run by the community, which manages a protocol infrastructure level. That's Tide.
So I guess the first question would be, there are different ways to find investors, right? There's the VC route, there's the angel route, there's this kind of route where you're using Telegram, there's the route where there's all these different approaches. You get the advisors, the consultants, the introductions, the events, all that stuff. Where do you find, are you guys getting what is your strategy, overall, and what type of investor are you looking for? And then 2, how are you finding and how do you feel the challenges are now with the crypto winter in play?
So with us, we're doing Reg D fundraising, and we're opening up our round to accredited investors only. The way that we've been capturing a new audience and getting interest for our product is by going to events like Sundance. We actually had the largest activation on Main Street in Park City, Utah. We were there a couple of weeks ago. And we actually had a live demo machine, people coming in and buying Raven coin and Ether and Bitcoin. And a lot of these people had never had any type of interaction with cryptocurrency whatsoever. So we created a really beautiful process where people came in, they were educated on the technology, and they were able to interface with it. And like the gentleman from TapJet says, it's basically creating a community where your customers are also your investors. And because this is all very new and it's attracting an affluent crowd of individuals, it creates an environment where the pitch can be a two-way pitch. And word of mouth is very important. Actually having a working product. I think everybody on this stage has a working product, so yeah, that helps as well. I think that we got into a period of time where people were throwing anything that would stick to the wall, and people would throw money at it, and they'd had nothing, smoke and mirrors most of the time. So people have wised up because there's been a lot of wealth lost through the crypto winter, and yeah, that's kind of how we're doing it right now.
Look, I think I find myself apologizing for this throughout the entire conference every time I meet someone, because our team is really not a crypto team. So, you know, we talk about the crypto winter. We've really been oblivious to that. Our fundraising has really come from enterprise-level businesses that have wanted to adopt the protocol, and in doing so, have introduced us to their venture arm. And I think that's also sort of a natural progression from an STO side, because a lot of these guys are publicly listed entities. They wouldn't have the ability to hold utility coins on their balance sheet. So for them, it's, and in fact, almost all of our funds today have been from, I guess, adopters of the Tide protocol.
So do you have the token, the kind of security token itself? Are you doing like the hybrid version where the token can also be utilized as part of the platform, or are you completely separating it? It's more like
No, we are separating the security aspect from the settlement token that actually runs inside the protocol. And again, sort of keep things in the fiat world, that settlement token is just a one-to-one backed stable coin. So it's just, it literally is just moving money around.
A speedy process. It's getting rid of the friction of moving around the money.
That's exactly right.
So in our case, we're lucky to be in Denver. I'm sorry, not Denver, Delaware. Morning is still getting to me. But in the Delaware, last year before, they passed a Reg 219, which kind of puts a frame around how you can issue your securities. In the case of Delaware, they publicly allow you to do it on the blockchain. So that became a decision, right? How do you function in a hybrid world? And in reality, again, if you read the placement and offering memorandum, we just basically say, if you are a new generation investor, we'll issue a token. However, you can call us any day. We'll issue a certificate, copy of it, with a hex number on it, and we'll still create a token for you, right? So we have to make ourselves appealable to old and new generation
That's a good idea.
Of investors. If you invest in the cryptocurrency, we're still going to put it in the escrow account, and we're still going to meet the cap, and we're going to issue. And then it becomes, again, the idea of this is we're blazing the new trail. So we have to take what I call the legacy investors, or the folks who don't understand what we do in the wallet, who probably never will have a wallet or might not even know how to get one, and walk him through the safety path And then when they, at the end of the path, we say, do you understand that you own a digital security right now? But if you would like to have a paper copy of it, and it stemmed from, we still have paper wallets, right? Even in the current issuance method. So that's how we approach that.
Interesting.
We have to use whatever minimal regulation is available today to be able to refer to create a safety path considering the events of the crypto vendor.
So all three of you are doing U.S. regulated, you know, the Reg D process and so on.
So we're in the Reg S.
Reg S.
And Reg D, which is again is one of those another trails that nobody blazed yet. We have to clearly delineate between what the accredited investor is coming into our investor portal versus someone outside the U.S. And Michael talks about you could potentially create U.S. could be left out of the market. That was not the issue. The issue after the investment, how we now manage this community of investors and report to them, right? And what trading will go on offshore, and then what platform, and how the U.S. guys are left out because they have to hold on to it for 12 months before they can do anything.
Yeah, so I guess so do you want, I'll start with, you first, but do you want your token to trade on exchanges? And have you had any exposure and had any type of discussions with all of these exchanges that are trying to pop up with the ATS licenses and all this other stuff, and how's that going?
Yeah, absolutely. So the tokens on the Vault Logic network essentially allow you to provision a machine. So the minimum buy-in for a machine is $20,000. So that's also the minimum investment in our STO. We're raising an initial 10.
Wait, so but do you get a machine when you invest the extra 20?
You do not own the machine. You're provisioning the machine on the network.
Okay, but
the owner of the
you're not being shipped one to put into your store or something.
No.
Okay.
Now, if you want to become a deployer on our ecosystem, you can play both roles essentially. You can invest in the STO, and then if you find a location, you'll get a couple of more points for housing the machine at that location. And yeah, absolutely, these tokens are going to be fully liquid. They're going to be traded across hopefully many different exchanges.
We hope.
Well, that's the goal, right? Yeah.
And so which exchanges have you spoken to any of the ones that are claiming to be exchanges, like the Open Finance guys, or I know that there's Open Finance and T0 finally launched their first token on an exchange, but just as an FYI, no one has been approved. No one has been approved in the U.S. to have a secondary trading market for a token. So so they're not really exchanges. They're almost like wallets in a way, swapping, or it's not the same level of exchanges that you would expect. So what's going on with those conversations with the exchanges?
So no one has been approved in the U.S.
Right.
There are several that will talk to you under certain terms and dollar allocations to outside of the U.S. And the minute they realize you're doing it, they're all calling you. And I think the reality here is, I think we're trying to disrupt with cryptocurrency, STO, and ICO. We're trying to disrupt something that's been built many, many years.
Right.
And by doing so, we might be leaving some people in a dark or offending them. So let's look at the basics. What is our obligation as a company first? It's to our shareholders. If it's your STO purchasers or shareholders today, you have to give them value. We're not thinking about the IPO today. Why we're not thinking about IPO? Our job is to give value to the investor today, and that could become by a private equity buyout, by any other means of exit. So why would we, that early in stages, right? Because everybody who's doing STO, or at least on this panel and has done it so far, we're in such an early stage to even talk about trading that we should stop and concentrate on giving value to individual shareholders. And that should be the focus of every person who is raising capital, is how you raise more, or how you give equity or value back to the people who believe in you today.
Yeah.
But, I've got a question on that. So if you've got investors, they're looking to invest in your business. How do you provide that value without providing liquidity?
the liquidity is a sum of activities of your business model. They could come of several ways. Dividends, if you have a high cash flow model in our case, which is the case, so the dividends could potentially exceed the investment under a business model, or at some point an exit. It could be an IPO. But what I was trying to say is the companies who sit at the early stage of a STO or any kind of revenue.
But some investors want. So there's two issues. One is the ICO speculators, they all got killed, right? This market just destroyed them, right? So they're all running for the exits. So the people who want to invest in your company, the interesting thing, like these pension funds, we're also talking about this, they want the liquidity option. Not that they want the liquidity, they just want the option. And most of the times, every like Reg D prior to us having, to this new marketplace, you couldn't transfer shares easily. In fact, actually, Equity Zen and those ones that sell like Uber shares and all that stuff, a lot of times Uber, those companies will try to shut that down. They don't want their employees selling their stock to someone else. But so I do think you're right, Isaac, where they want that liquidity option, and I think that's why it's a benefit. And then, but when you're talking to investors, are they? You seem to be in the mindset where they're not really that excited about the kind of liquidity issue, whereas some investors are. How is it going? Like when you have these conversations?
Look, I think from our end, the Tide security token provides you with a gross revenue share model. Now, in the old way, that's just a net present value calculation when you take a look at what is the value of that token today. So taking the liquidity off really also takes off the net present value calculation, and that's something that is detrimental to the entire network. So for us, ensuring that there is liquidity in the network is important. And yes, you're right. There are no exchanges that have been approved to operate, at least not here. And even if there were, quite frankly, I'm not sure that there would be a whole heck of a lot of trading on there, a lot of liquidity. So for us, we know that that's coming, but we need to address it today. And the way that we address that today is to effectively become our own market maker and provide liquidity internally.
Okay.
And that's our solution to that.
So if I know that in the Japanese market, there's two exchanges that can do STOs that can trade them. La Token, which is actually based in Russia, but they have actually offices here. They're trading because they want to trade STOs. We also know that like the OK Coin guys, or the OKX guys, I mean, they. I talked to the person there who works in the U.S. and he's a former a kind of capital markets guy. I think he was at UBS and actually Lehman, and they're just going around the entire world and getting approved jurisdictions in like every jurisdiction that they can find. I think he rattled off like 6 countries or 7 countries. It was crazy. So I know that. So if those exchanges come to you and say, "Look, we'll trade your STO. I mean, we'll trade your token," will you allow that?
Yeah. For us, if it means providing additional liquidity, and the right security, then yes, we will.
Anyone else?
It'd be up to shareholders to approve.
Oh, interesting. That's an interesting approach.
Echoing him, shareholders, board of directors, CEO, all that. I don't know what the legal implications are to getting listed on an offshore exchange for U.S. securities or registered U.S. securities. So I really wouldn't be able to opine on that.
So I want to bring up something that happens in the actual public markets, like the activist shareholder, the activist investor, proxy fights, proxy voting, all that nonsense. What are you guys going to do if that ever, are you going to be ready to almost act like a public company? And how are you going to report? If there's no you don't really have to report to your shareholders as a Reg D, right? There's no kind of reporting requirement.
So with our model, you're basically buying a royalty contract. So you don't own any piece of the company. You don't own any piece of Vault Logic Incorporated. You own a piece of rights to revenue generated by machines within the Vault Logic network.
And are you going to be audited?
Well, yeah, there's going to be internal auditing practices, and then we're partnering with MSBs across all 50 states. So they have their own, they have their own requirements for compliance and registration and all that. We're a software as a service. Right. So we provide the technology and the tools that enable licensed money service businesses and other providers and institutions to interface with our application and give users like that end experience.
So will you give them a monthly report, a quarterly kind of report? Are you going to send them numbers? You're going to send them like how are you going to let them know what they're like?
So it's quarterly.
I just get a check, but I want to know how does that kind of tie in? Well, not check a coin. How does that how does that tie into the overall value?
Right. So we have the consumer-facing side of the business, which is like the Vault Logic machine, and then there's an entire back-end process that we've developed. Okay. There's an administration panel where not only can we set the margins that each of these machines make on the snap of our fingers, but we can do customized reporting as well.
So this is important because what you guys are doing is actually you're doing like best practices for a public company without the SEC even telling you to. And that's good for the entire industry.
So let me just add to this. We're the software guys, or we're a tech company. Before we did an SDO, we probably spent more time on building an investor portal, our own product, than we spend on PPM. As a shareholder, we live in a transparent world, right? First, your share is on the blockchain that was legally approved by the state. Second, if I'm giving my board of directors a report monthly, why you as a shareholder are not entitled to one? You should be, right?
So that's true, but though there are activist shareholders, and they're not, and just because they call themselves the activist shareholders, they're not always the nice. I acquired a proxy kind of solicitor firm for a fund back in, 2007 or something. And it was a big proxy shop. And we used to work for the companies and for the activists sometimes. And you know what? They're not doing it to be friendly, okay? Like Carl Icahn is not a friendly guy. So what are you going to do when, in some ways, being private, you don't have to share all of that information? Why would you do it?
Well, here's this. I mean, it's a premise of why we went to raise funds as STO. I want my customers to be the investors. And if they're my customers and they're telling me I'm doing something wrong, what's wrong with that? Or if they want to take it...
But it could also hurt your sale. So in the private company world, right, you might be having problems on the financial side, but now you're telling your customer that you're also doing that, and they're going to stop using your product potentially. So there's risk there.
There are risks, but in the world of transparency, you can't be selective of what you share and what you don't share. Either you're open book or you're closed book. And I think after what we've seen in our space, to be vague on trust is not an option.
This is like the opposite of ICO.
I think I totally agree with the openness. For us, there is no the openness. The whole transparency piece within the Tide protocol. There is no central entity. There isn't an equity-based company, and so the Tide token is programmed into the protocol. And the protocol spits out a revenue share back to the token holder.
So it's actually programmed into the system.
Exactly, and that system is open sourced.
And that's decentralized.
So when we're talking about auditing, there actually isn't any more transparency than that. And so there are no shareholders buying a percentage of the overall revenue. Does not mean that you are a board member on the foundation, which is non-for-profit. It's completely separate with a separate mission.
And that's cool. Like we're actually seeing reality with real companies. Like you raised already $6 million or like kind of $8 million. So we're seeing real companies, and he has real revenues and real actual profitability, and you have real machines, and I know you guys are doing a lot of great stuff, but we're actually seeing like really, really innovative ideas around the control mechanisms. Like the SEC is all over the Investor Protection Act, right? They want to protect the investor, and they put these onerous things on top of companies in order to kind of comply. If you do blockchain and you put everything on a blockchain, including the revenue share, it's already audited. There is no audit. So you could actually wipe away, which I think is going to be a little scary for the PricewaterhouseCoopers of the world.
Huge savings. Huge savings.
So it's really interesting. So what are you guys doing now to court? Like, are you looking for the strategic investor, like the person who's going to bring you like partnerships and business development opportunities and so on? Or are you guys just looking for like the passive money?
I think there's dumb money and there's smart money, and especially at this stage of developing a network, you need to develop that network. And for us, all of our investors have been users of the protocol, and we'd love to be able to see it continue that way.
And Mills?
So we absolutely are looking for money that can provide value and not just sit in a bank account or burn away. For example, we've taken on an MSB partner, and we're going to be launching 7 locations at Simon's malls across the country. So this little test pilot that we're doing with this person who's essentially buying the machines or buying into the STO that gets them the machines, he's also creating a situation for us to potentially expand across the entire country at every single Simon's Mall if this pilot goes well.
So that's the type of investor, yeah. So you know what, too? It's like the node operators also. So that guy's almost like a node operator, right? So it's almost like not a mining. It's like a mining concept, but without the mining.
Right.
I run the node. I am the investor. I'm not only buying the node. I'm getting a piece of the revenue share of the actual parent company, and then I'm also potentially even doing other things. So that's really the active. That's a positive active investor.
Right, and we're another example, if I may. We have a crypto evangelist also putting money into us, Jason King.
Okay.
And he created one of the world's first nonprofit organizations that allowed people to give Bitcoin and other coins to homeless people and like less fortunate. And getting those type of crypto evangelists on board to push the platform, I think, is key for us to succeed and incubate the concept.
Cool.
So for kind of continuing on the previous question and answering this one, we already said we're going after potential customers.
Sure.
But for everybody who did an ICO in the past or doing an STO, the advisory board. We welcome the active investor. As a matter of fact, front page on our website is a situation where you want to be an advisor, invest. If you invest a certain amount of dollars, right there, you get a level of advisor. You want to be an executive committee, invest more. You want to be a board member, invest even more. It's the same conversation we had with VCs 10 years ago. If we give you X, we want to have one of our guys on the board.
So put skin in the game.
Put skin in the game, but it has to be a win-win. And what VCs used to do to us in the previous exits, right, is inserting them into decision maker or inserting their capabilities into decision-making process. We should embrace it.
Yeah, but I've seen, like, I had an investor in my last deal where I raised about $9 million. It was a turnaround, and this turnaround, and this investor had no idea about the equity cap. I know the small, anything that we were doing. He was a lawyer, and he would not stop me from. He would stop me from going out and getting funding elsewhere. I eventually left because this guy diluted everyone down, and at the end of the day, now the company is actually in a worse shape than because I brought it back. And he destroyed the value. So you're going to have issues where just because someone writes a big check, that doesn't make them a good investor.
Okay, but the page 3,
a good shareholder.
But the page 3 of your offering memorandum says you don't have to take every investment given to you. And why are you as a company should not interview the investor? Again, going to our offering page, we allow you to interview us before you invest $1.
It's a mutual
And we
thing.
look for the same. So you pick who you play with. If you're looking for a bridge loan and you emergency have to raise an ICO, we're not talking that situations here, right? We're all companies with products, and somehow we got here. But if you don't interview your investors, that's a problem. And you can't find yourself in a desperate situation where you're not given the opportunity to pick who you're going to be. And if you did the due diligences, yes, you're going to get a bad apple, then fire them. Just like you can fire customers, just like you can fire team members sometimes, you should be able to fire your investor. But you can only do that if your foundation is strong enough to take that firing, right?
Yep. You want to answer,
I
Isaac?
think I empathize with these, with the challenges that you're bringing on. I think for us, again, it is very different. An investor in a security token effectively invests in the revenue of the network. The Tide Foundation is a non-for-profit entity.
So you don't have to deal with any of this.
Membership in the Tide Foundation is based on the contribution into the network. What did you do in terms of processing? What did you do in terms of supporting the network? And that foundation and the board members of that foundation are there to govern the protocol. So you can invest as much as you like, but you're not going to be controlling the network.
So it's kind of like a DAC on the foundation level?
Exactly right.
So you know what, I mean, and what's cool here is that you guys have you're all doing SEOs, you're all doing the same kind of reg, but you actually have three very different business models on the approach. I think that's the cool thing is that, it's not just about equity, it's not just about raising debt. I was thinking about this, I was like, on the actual balance sheet, eventually, like with the tokens and all this, how are they gonna write it down, right? And they may have to come up with, FASB or something, may have to come up with a new approach to the balance sheet that applies this in a certain way because it's different. It's new.
So under current GAAP and FASB, token or any kind of cryptocurrency for that matter is an intangible asset.
Right.
So I'm still...
An intangible asset.
Intangible assets. So I'm still surprised of how you do, and maybe they're smarter people than we to date are. So our offering memorandum addresses it simple. No matter what currency you use to invest, you're investing in a USD equivalent security, you're issued a security, and it's recorded just like a standard accounting practice. And I think maybe that's a stepping stone in the evolution of this kind of regulations. But if you're offshore, the only difference from a Reg S perspective in our case is your certificate will have a note on it saying that you can't sell it to US, right, when we issue it. And your smart contract that issues the token will do the same.
So you know, that's
So we don't have to write it down differently to answer your point. We'll continue to follow what's there so we stay within the letter of the law. But at the same time, we're making small adjustments in our behavior to accommodate the scenarios that come at us.
And you're all actually KYCing and doing the AML stuff, and you're probably using outside sources or inside sources, like whatever, right?
Yeah, and the goal right now is to outsource any kind of liability related to vetting of that, because there's still uncertainties in terms of what's considered a due diligence or sufficient due diligence on behalf of ourselves. So we go to a third parties. In Reg S, it's even more interesting. There isn't a Reg S company that does it there. So that could create some potential exposure in that regard. But as far as, again, we following the letter of the law here and vetting the investors who are investing, I think we might be in a good shape.
So one of the challenges, I'm going to stop now, and if you guys have any questions and stuff, but I think one of the other challenges with the Reg D offering is there's and I'm hearing confusing things, and maybe somebody could tell me which one it is. But I know that there's a cap on how many investors you can have in a Reg D offering, and then the other problem is when you trade on the secondary market, the secondary markets are going to have to be able to do all the KYC and the AML for you, and then supply you with the shareholder list on an ongoing basis, or at least give you access to a shareholder list, because you have to be able. The difference between like they were talking about street name, right? So with this model, you don't really have to have street name; it just goes away, Okay, you don't have to have a broker-dealer really hold the shares or hold the tokens for that person because it's being traded almost in like a decentralized way. But all of that stuff has to be whitelisted, and you have to make sure you don't go over that number of investors. There's these like little rules and issues that are going to come into play. Have you guys even thought about that stuff yet, or is it too like myopic around the capital markets?
Not giving anyone legal advice, right, at this point.
And neither am I.
But on the 506C, technically there is no limit unless as long as they're all accredited and verified accredited investor. There is a limit on how many non-accredited you have, but we ruled that out. We will not accept a non-accredited investor in U.S. for two reasons. One, we want them to be mature investors to eliminate the problem we were talking earlier. So let them be accredited investors. So that goes along in the situation of accredited versus not accredited under Reg S. The second problem that we would run in, and I think that's where regulators have to come in someday and fix the problem, is look what a non-US person does in our world. They go to our website, they read an offering memorandum, which is almost identical with a couple more disclosures, and they hit subscribe, fill out the subscription, and pay. A 3-click user experience, right? That's what greatest technologies are built on. Now, if you're a U.S. investor, here's how your process looks like. You go to our website, you get an offering memorandum, then you fill out the form to verify who you verified are. And after you verified who you verified are, you have to go and sign a subscription agreement. And after you sign a subscription agreement, it has to be counter-accepted. Our attorney has to evaluate it, and only then you can pay. We're just, it's two different processes. It's not limiting by any chance. It's just more time-consuming and more agitating to the folks in the U.S. than any.
It's onerous.
Yeah, but it's a limiting factor because those are busy people.
Anybody else? All right. Any questions from the group of folks here? No. You guys are done talking about the kind of the boringness of the actual the kind of capital markets and exchanges. So, all right. Well, guys, thank you very much. Please give them a round of applause. I think it's really innovative. Thank you, Michael.
So our next family office panel, David Drake is detained in New York, and James is on his way, but dead air waits for no one. So, oh, you are here, great, fantastic. So we're going to do this as a fireside chat. Okay, so we're going to get started now. Family offices has been sort of this big category along with sovereign wealth funds and institutional investors who's supposed to turn this into like $1 trillion market. And we've been sort of like waiting for Godot for family offices to get involved in the crypto marketplace. They certainly kind of sniffed at it during the ICO period and kind of ignored it a bit, but they have been buying Bitcoin, and it looks like, from what I've been talking to family offices, that they continue to at least say, I like Bitcoin, I think that's going somewhere. Either maybe I'm going to wait a little bit until, Bakkt launches or Fidelity does it. James, why don't you tell a little bit about your background with Consensus and now your new firm, and then sort of where you see this kind of like, incredibly large family office world, how they think about our industry, and are they starting to at least consider putting, 1% of their wealth into it?
Sure. Pleasure to be here. So my background is essentially, I've been in the capital markets business since the late 80s. I was the head of capital markets for Consensus for the first 3 years, and essentially it was meeting with a lot of the different stakeholders, either doing blockchain 101 or diving into it much more after they really understood the technology. So I got a great bird's eye view and really trench view of what can we do with the technology, and putting that on one side, and also what can we do within the asset class itself. Throughout that time, I founded Consensus Capital Asset Management, also started my own family office, so I can speak to some of what the family office business is. And then left Consensus last spring to launch basically a CFTC regulated investment fund. And essentially leaving Consensus was only because we had over, I don't know, 1,000 software developers. And you can just imagine trying to be able to work within a regulated confine and also have a lot of people that don't really know what that means. So it's kind of from my background side of things, I actually look at the marketplace as now we're still in a mode to set the foundation. So I feel that most of what we've been doing, let's say a couple of years ago, where people got really excited about Bitcoin, ICOs or token launch companies, Ethereum, all of that was assuming that the technology was already done and that we actually weren't in beta or alpha. And this was already hardened tech that we could build lots of applications and we could move forward. Or we're going to replace the internet, and now we have this magical new technology that completely works. And I think that's, I mean, well, it's just not the case. I was just having a conversation with someone who described themselves as a crypto kid, and the way I look at this market is we have two different things that are going on. We have basically this spectrum of, we have the blockchain decentralized world that could create our new Ubers and Airbnbs that will be doing one-to-one and all these different things that almost we're creating this art of what's possible. And then the other side of it is essentially the regulators, the traditional financial institutions, all those groups, and it becomes an educational process, right? So getting them, they can't play in this world yet. And they can't even, that basically gets them extremely frightened. And so it's really showing them, here's what this technology can do. Let's get you to one step forward and now be able to understand, oh, we could have a wallet that holds an identity and then it just provides those attributes but not the actual person's name, but we can still have all the same validation processes that we go through. That's a huge step for a regulator. And so those are the parts where a family office, they're looking at this space to say, okay, the technology first needs that scalability, that ability to actually have adoption before we can really make this an asset class. So the way that Dharma is set up is we're looking at this as, for the next 2 years, we're going to be talking a lot about scalability and tracking where adoption is. But right now, I would just say that we have an asset class where we're just all almost playing and trading amongst ourselves, right? Everybody that's a crypto kid or a crypto follower, great. We're just seeing, do we want to adopt this, right? And applications that say, I think you have, what is it? About 100 wallets did about 70% of all the investments in ICOs. Now, you can obviously have some of those wallets as aggregators for other investors, but just to think of it, that's the scale that we're looking at right now. So I look at this more as tracking what that adoption is, looking at it from a protocol layer, not from applications. And as we go through that and that part gets more developed, that's the tech side of it, that's going to be fundamental for driving more interest, which then drives more market cap, liquidity. From an asset side of things, I look at this, and we're very instrumental within helping push this, is what are the institutional infrastructure that's needed, right? I mean, Dharma has, KPMG is our auditors, Greenberg Traurig is our lawyers, Duff & Phelps is our compliance. We've taken all of those traditional institutional service providers, but one of our keys that is missing is our custodial. You know, so we're using the traditional type of players of Coinbase and Kingdom. We've had to go to Lloyd's of London just to get a wrapper so that we can say, here, now we at least can say, we get that our service provider isn't as strong as what a traditional institutional investor would want, but at least we're trying to, you know, increase that credit risk, right, or I guess decrease that credit risk. So the asset class needs, let's call it a regulated, institutionalized, over-the-counter market. We need true institutions. So as Fidelity looks to come in, or State Street comes in, and Nomura comes in from a custodial standpoint, our auditors, they're still learning. KPMG and Deloitte and everybody else is still in the how do we do this, because we don't have enough clarity. So, you know, from a technology standpoint, there's still a lot of build. And from an institutional infrastructure, we are doing it. And I would say that a lot of family offices and the pension funds, they're looking at this space. I would absolutely not tell them to put a percent of their assets in there. You know, if they wanted to take a flyer, sure, they can go do that in their own PA account, but they shouldn't be doing it. I think that
you would not recommend that somebody at 3,800 put anything into Bitcoin, even though the sort of historical trends show that we're probably at or near the cyclical low of the 4-year markets.
Yeah, I would say in this sense, if you're looking at it from an institutional standpoint, right, you are only going to have really a handful of outliers that will do that. And those family offices may say, oh, I want to be more aggressive. And so I do want to be in, because I think, oh, I'll be getting in at, you know, at these low levels. But it's going to be then inside of an entity that makes it more cumbersome. You know, like that's why Dharma got created, is to say, we're going to create a very institutional thing for an asset class that is, you know, much more, you know, new to them.
But I mean, for the most part, I mean, that's the whole, it's actually considered safer in a lot of modeling to have 5 or 6% in high risk, high reward. You know, you're going to have the rest of it in, you know, pretty safe, you know, real estate funds that are historically done 15, 16% or whatever, and S&P and like hedge funds and, you know, more traditional stock market, real estate type investments. But you got a portfolio driver. That's why Stanford University puts, you know, money into Sequoia Capital, because, yeah, they could lose it all, but, you know, they've had years where they tripled their money, and that helped their overall return.
Right. Except Sequoia is regulated. And so that's the hard part for these kind of groups to be able to make the investment. I mean, I speak to several different pension funds. They can't make the investment, just from a regulatory standpoint. I mean, as a regulated fund.
They can buy gold, though.
Yeah, exactly.
And gold is not regulated.
True. But it's an asset class that already, their compliance, their legal has already said this is okay, and we don't have other suspect type of risk issues, essentially, that they just don't understand. And so, you know, that's where it's, you know, our counterparties, we have to KYC them. We have to go through all those type of checks. So when I look at decentralized exchanges, you know, yes, I see that as going to be our future, but as a regulated fund, I can't use it, right?
Well, I was going to say, I think centralized and decentralized exchanges are going to both exist in the future. I think that you're correct. You're not, just as self-custody and, you know, old style Back to the Future custody, where you know, even though, you know, having it in a Trezor and a safe, et cetera, is self-custody, you know, you're going to feel better if it's a Trezor and a safe that's got 3 keys and it's under a mountain in Switzerland and Zappo's doing it, and they're going to say, well, gee, does, you know, State Street have a similar product? And I mean, Prime Trust right now is like getting a lot of business, and you know, there's a number of other ones that are basically saying, hey, we're going to do old-fashioned custody, and you know, they're just like triple-digit increases in revenue, and because I think there are a lot of providers like you that are like, I need this to make the CTFC happier, to make the SEC happier, to make whatever regulator. So you mentioned you're a CTFC regulated fund, so you're just doing digital commodities and nothing that would be considered a digital security, and how in this age of uncertainty do you know the difference?
Exactly. Well, and I was going to say on the custodial side first is just that I look at all of those as basically acquisition candidates for when this market does take off. State Street will acquire a couple. Boney will do the same. So will Nomura. Essentially, if you're a large fund, you're trading derivatives, fixed income, convertible bonds, and you have your equity. Now you have your digital assets. You have all these type of things. And so to just have one group that says, here, this is the only part that I'm doing, they're not going to understand even how to interact with a large institution. So on that side of it, I think it would be more of they're going to help pave the way and pave that infrastructure before, you know, and then it becomes a larger institution comes there and goes, yeah, we will have the keys in the mountaintop and such. And the other side of it you were asking is?
Why CTFC regulated, and can you tell, or are you just investing in Bitcoin and Ethereum? And how, if you're CTFC regulated, do you know that you're not essentially making a venture investment in something that is considered an SEC, you know, under the SEC wing as opposed to under the CTFC, since the SEC has been very vague?
Right. So Dharma has a investment thesis, and it basically kind of goes along the lines of Web 3.0 protocol layer investment, where you're having transactional layer, storage layer, compute layer, messaging layer, and looking for what would be those core assets that someone would want to acquire if they wanted to have a representation of what the digital asset marketplace is. Okay. And so for so we
protocol tokens essentially.
Yeah, and so we just announced our Dole ETH, so Dharma Optimized Long Ether Fund. Basically what it does is it tracks what is Ether doing, so that's our benchmark, and so over the last year and a half, we've outperformed by 155% to the benchmark. So we wouldn't say, oh, Ether is the be-all and end-all. Coming from Consensus, you know, I absolutely drank the Kool-Aid there. But it's more of, yes, that should be a core investment. It gives regulatory clarity, it has liquidity, and it falls in line with our investment thesis. So from that standpoint, we look at it as, that's something that, if I was an institution, that I would be able to purchase.
Would you, since obviously over the last year the price has dropped quite a bit, would you be looking at other things that are Ethereum ecosystem that perhaps expand some of the capabilities, like a MakerDAO or like some other tokens that simply run EVM that are not Ethereum?
So it would be another strategy, right? So we have a Dharma Optimized Long Ether. We're going to be issuing other ones. MakerDAO in particular, we probably wouldn't have a fund of it, but we would utilize it. So we use that from a funding mechanism sometimes, and we work fairly closely on that type of strategy. But it wouldn't be, here's the next new application that's been built on there. I wouldn't have the liquidity.
So essentially, are you mainly Ethereum long then in the fund?
It depends. I mean, in that fund, yes. That it's basically fiat, Bitcoin, Ether, and so it's more to say, oh, you could have been a token launch company that raised a bunch of Ether and just watched, they held their position and just watched it go down. And, you know, obviously these token companies aren't trading groups just because they know the technology well. They're to build their technology. And so they should have treasury management done professionally.
So treasury management would be a big part of it if somebody like raised a bunch of Ether. I mean, not that that's happening right now, but if, say, 12 months ago somebody raised a bunch of Ether, you would basically go in and say, here, we're gonna go and, you know, look at the market, turn a certain amount to cash, buy back on a dip, go into a Bitcoin when we're, because you're basically just looking at trends of two tokens on charts and other, you know, ways that you evaluate this as a algorithmic trader essentially. And then, I mean, are you doing, if you'd started this fund a year ago, would you have gone short at any point, or was it completely long and back and forth to fiat strategy?
Yeah, well, so a year and a half. So we essentially what we look at is from 0 to 100%. So we would either be into fiat or we would be, you know, long in, Ether. So it's the only way that we would have a difference of a 0 to 100% ownership would be more from the investor saying, I want to first leverage before I go into the fund. And so we have a banking relationship that provides that.
Interesting. So where do you see the family office market and the institutional market 1 year from today? So 1 year from today, we're going to be only 2 months from the halving. And we're going to be past the full year, which will either be up or down. If we're following the 4-year charts, we should probably be up, not dramatically, but 2015, you know, had a low of 150, and I think it ended the year around 400 and started the year around 200, so that still is double in simple math. And I think if we ended up the year between 6,000 and 7,000, that is double if you bought in January for Bitcoin at least. And you know, if Ether ends up the year at, you know, 250, 300, that's also going to be in that range. Between now and then, from the regulatory perspective, I think, and from the launch perspective, I don't see any scenario where BAC's going to delay beyond the end of the year. Fidelity certainly should at least be close to launching, if not launching. NASDAQ, with their exchange, said they're going to launch first or second quarter. You've got, you know, the San Juan Mercantile Exchange that keynoted yesterday, and hope you can make it to the cocktail party tonight at Bo Collins' place. They'll have the whole team there. You know, and they're going to be providing the Charles Schwabs of the world with this type of, you know, Bitcoin liquidity. And I'm sure more big players will get into the custody game. Do you see by this time next year that family offices and institutional investors and maybe even sovereign wealth funds will say, okay, there's enough regulation, I can look at it?
Yeah, well, I was going to say a bunch of what you kind of ticked off are important from the institutional infrastructure, right? So yes, we will have more custody, stronger solutions. That'll absolutely happen. One of those platforms, or maybe a few of those, will be great for institutions to be able to trade and transact with each other, so that helps facilitate it from the asset side. The other side of it will also be, it's not just a trading game to say, here are what the charts say, but from a technology adoption side of things. And I would say as more of these technologies get hardened and that you can actually have true adoption outside of our crypto space, that's going to lead to larger market caps. Larger market caps mean a sovereign wealth fund could come in. Right now, it's negligible of how much they can make.
I was going to say, I talked to Tomasik at one point and said, are you looking at Bitcoin? They said, I can't look at that until it's regulated. Yeah. So if all of a sudden they feel it's regulated, right. Then, I mean, all you need is, you know, 1 or 2 Tomasik size funds to say, hey, we're going to put 0.25% of our, like, you know, $70 billion, what I think it's Norway, I was reading, is the largest sovereign wealth fund. Norway, $1 trillion.
That's interesting. I didn't know that one.
Yeah, I just read it the other day, but I mean, so if you add up all these sovereign wealth funds, you add up the family offices, and you do tenths of a percent. I mean, a stat that I read a couple weeks ago was that if every accredited investor, millionaire, it's not even accredited investor, if every millionaire in the United States wanted to buy one Bitcoin, there wouldn't be enough of them to go around. Not just the rest of the world.
Yeah, I mean, the supply side of things, I mean, it needs to be a technology, right? I would still be looking at this from where the conversation will be over these next couple of years. We'll lay the infrastructure, but it will also be where are we at within a scalability or within a use within that time period. And as both of those are going in conjunction, that gives us that opportunity for those institutions to come in.
So on the technology side, on Bitcoin, you're looking whether the Lightning Network really takes off.
Yep.
If it doesn't, it's really just going to be store of value. And somebody else like, whoever, Dash, Bitcoin Cash, maybe becomes the, Ripple becomes the faster, better, cheaper way of doing this, as well as stable coins. Mm-hmm. What do you see stable coins effect being on the market?
So I'm personally invested in True Digital Holdings, and what that's doing is it's creating sort of a stable coin for mid-sized banks. So call it the $50 billion banks now don't have to go to the JP Morgans of the world, but they can tokenize their own holdings for their customers, and now they're able to trade. Though I still see those as the type of token, stable coin that can be used, because if I can hand over a thumb drive of $5 million to you, the regulators are not going to let that happen, and you're going to have a big fight for institutions to be able to do that.
But so far they haven't shown any indication of shutting down Circle, which is owned in large part by Goldman Sachs, or even Tether. Yeah. And I think because that, I can hand over a briefcase of $100 bills too. In fact, if anything,
it's much more cumbersome to do that though, right? And so let's see when you have traditional banking, right? Instead of the Wyoming to go here, we're going to have these special purpose banks, right? Or we've had discussions in Puerto Rico to do the same thing. When we have our traditional Bank America, you can open up your account, you have your Bitcoin and your other kinds of Tether coins and things like that, or you're a company that's able to be banked because you're in that space. It's a completely different world. Right now you look at Circle and go, what is it? What's Tether? The regulators are still, I would say, they're still learning and still having to come up with what that regulation will look like. But if it became, what I would say is it would be very difficult right now for corporations all to be interacting off of that kind of payment rail, right? Because it would just be, what is that backed?
Yeah. Oh, corporations, I think, will definitely use more of a back-end banking JPM coin, because it just basically is just the faster, better, cheaper SWIFT network.
Yeah, and that's just technology, right? I was commenting on the STO conversation, and I think it's funny because that's really just the clearing of those companies versus a special blockchain company as you take it to market. It's going to be much more of, okay, it's a technology, it's a database technology. How do we make our settlement more efficient? How do we move money more efficiently?
So I'm going to hand it over to the audience for questions. We covered quite a bit of ground here. Let's see, Mariana, are you in the room? I was going to can someone other than me pass the mic around? Or actually, I guess we have both mics here. Okay, cool. Just so we can hear people. So we'll share the mic, and esteemed volunteer.
You kind of touched on that briefly, but in your conversations, is there a discussion between the store of value used for currency, and that's mainly kind of Bitcoin, the world reserve currency for cryptos, but do you have those kind of discussions going on at that level, or is it just not even there yet? Because I'm curious, as you know, in our little bubble, we're deciding what this is, but at the larger, you know, more corporate level, are they even having these conversations?
Yeah, actually, I get to say it again. I wish he was here. So the banking commissioner here in Puerto Rico, we had a nice long conversation about sharding, right? So you have the spectrum of a regulator being able to speak to that side of the world, and then others going, I don't know what blockchain is, and I'm fearful of it, right? And any regulator is always going to come back to, how do I track my AML, KYC, right? Are you laundering money? Where's the source of funds? And that's not even just unique to blockchain, that's banking, and that's our world. So they'll always fall back to that side of it. So if they can't track, you know, the movement of that money, you know, like, you know, so our banking regulators, they can see where are the dollars globally, right? They'll go, I know there's X amount in this bank, and this bank, and this bank. You know, to lose control of something like that, it would just, I just can't foresee that happening. You know, we'll have our own black market ecosystem over here, but within the traditional banking world, and you'll have two different types of economies going on.
So sorry about that. In terms of your Web 3.0 thesis, investment in the fast protocols, right? Given your history with consensus, I wonder if you have any kind of preference for any chain. Is that Ethereum, or you open to any types of other protocols in the future, potentially creating new protocols?
Yeah, well, as I said, you know, I definitely, from the team, have drank the Ethereum side of things. But what I would say is that Dharma's set up more from these are assets that you should own, versus Ethereum's the best. Like, that doesn't make sense to me. You know, we don't know, you know, would Polkadot or would the Ethereum protocol make more sense, right? Or, you know, using a different kind of protocol. So it's just more of, after we've already gone through, let's say, our fundamental analysis to say this is something that makes sense, then we look at it from regulatory clarity, from liquidity, because, you know, our real end customer is an institution to be able to be invested in the marketplace. So they're not really interested in buying, I'm going to take a flyer on this and hope this token goes up, right? Because you can just end up having a large position in things that you'll never be able to sell anyways. So it's more focused on, okay, here is a protocol, or here is a digital asset that we find useful, and now, you know, all of us are either derivative guys or capital markets guys for the last 20, 30 years. So we're doing the same type of risk management that you would with any other kind of asset. You know, so it's not, yeah, it wouldn't be a very, like, call it just a brand new issuance that didn't have any kind of liquidity and market making.
I have a question in terms of, you were talking about cash and Ether and Bitcoin. The next three, you know, or four, you know, Litecoin, EOS, Stellar, Ripple, pretty substantial multi-billion-dollar market caps even in crypto winter. Any thoughts of, you know, adding those to your basket, or are you pretty much sticking with the top two?
I would just say possible. Again, if we were to add any of those, it would be another. Then it would be a Dole, you know, EOS. It would be a Dole, whatever. Versus saying to add it as a basket. I'm fairly anti some of the indexes where you have a bunch of them put together, because I don't think that they're really representative of what the market is. You know, for even while at consensus the entire time, I was just like, most of these you're going to wake up, they'll be 90% down. I'm not willing to put money into those, and because I don't want to go in front of an institutional investor and say, why are you down 90%, right? And so a lot of those, I was just like, we can't make the investment, and you were not going to have the liquidity to get out of the investment if we did. Like, Consensus, we owned, I don't know what, 50-some% of Gnosis. It looked like it was a $2 billion value that, well, it trades about 40 grand a day. It doesn't really help us too much.
I do just have one follow-on question. So in terms of your structure of your fund, is it a regular private equity fund with GP and LP, or you open up to potentially private partnership with private-public partnership?
Of what the structure is that what you're asking?
Yes, of your fund.
Yeah, we're a Cayman, Delaware master feeder fund, and the investment advisor and GP are both here in Puerto Rico. And then we have trading operations here, Chicago, Dubai. We'll be opening up in Hong Kong.
Great, thank you.
Sure.
So one more question, and then we're going to eat.
All right. Thank you.